Hello there. Today I present to you the first part of our September Uranium Report in a video format. For regular full reports, which are by the way the best you can find on the internet, make sure to join us at myfinanceteacher.org. Welcome to the report, and let's jump in. The World Nuclear Association now reports that globally there are 439 operable reactors. 64 reactors are now under construction, 88 are planned and 344 are proposed. Importantly, out of the 64 reactors under construction, 28 are expected to come online by the end of 2026. While the initial core loads for these reactors is already covered, this is a significant increase in demand within a couple of years overall. Additionally, many reactors that were supposed to shut down are expected to receive life extensions. China has nearly half of the world's reactors under construction. China recently launched construction of 2 new reactors, bringing their total to an impressive 30 reactors currently under construction. Recently, China also permitted the construction of another 11 reactors, a record number of new permits. They will require $30 billion of investments, with construction taking around 5 years or so. But in the next couple of years, among the 30 reactors under construction in China, 12 are expected to connect to the grid, with 3 of them connecting this year and another 3 connecting next year. Quick build-out in China aligns with their plans to have 150 gigawatt of operating nuclear capacity by 2035. Assuming a requirement of say 450,000 pounds of uranium per gigawatt per year, and with initial core loads requiring at least a double, China will consume over 500 million pounds of uranium in the next 10 years, and almost 70 million pounds of uranium per year in 2035. Additionally, and beyond that, China plans to have 200 gigawatt of nuclear capacity by 2040. That implies a consumption of almost 1 billion pounds of uranium in the next 15 years. Hence, global long-term demand for uranium is expected to continue growing over the years. Moving on to recent supply developments. Recently, Australia's Northern Territory refused to renew the mining permit of Jabiluka, one of the world's largest uranium deposits containing 300 million pounds of U3O8 resource. Nigerian government removed a couple of mining licenses, the mining license from Orano to mine the Imoraran deposit, which has 550 million pounds. Hence, its expected annual production of 13 million pounds per year over a mine life of 35 years is currently uncertain. And for the second mining license, similarly, GoviEx also lost its mining license for Madaola, which has 51 million pounds and was expected to produce 2.7 million pounds per year over the mine life of 10 years. Continuing within the topic of supply, Kazatomprom is of course the largest uranium miner in the world and accounts for around 20% of attributable global production. In my recent video from August, I was skeptical after Kazatomprom increased its production guidance, where they hoped to increase 2025 production to 80 to 82 million pounds. Kazatomprom has since reduced 2025 production guidance back down to 65 to 69 million pounds. Kazatomprom still mentions uncertainty around sulfuric acid supplies for 2025 and construction delays at their newly developed deposits. So for industry updates that do make sense, make sure to follow us at myfinanceteacher.org. Additionally, Kazatomprom's Q2 2024 inventories of uranium fell to 10.8 million pounds, just over 4 months of current production. That is the lowest in 10 years. Furthermore, Kazatomprom is sending fewer pounds to the Western countries. In the first half of 2024, only 36% of uranium sales went to Western countries, while 64% went to countries like China, Russia and other Eastern buyers. Remember that in middle of 2023, in my video from May last year, we discussed huge Chinese long-term contract signed with Kazatomprom that was so large they required a special shareholder voting. So again, for the best uranium reports, as well as the reports on other commodities, join us at myfinanceteacher.org. Grant Isaac, the CEO of Cameco, in a Q2 2024 earnings call said that the days of easy and cheap pounds of uranium out of Central Asia are essentially over. The global cost curve is going up and we're going to need to see sustained higher prices. Kazatomprom's warning of production in 2026 and beyond is fundamentally bullish for uranium prices. This is a clear indication that fundamentally spot uranium prices have likely bottomed. That is a quote from Grant Isaac from Cameco. Continuing with our report, there is virtually no risk that Kazatomprom could significantly increase production in the next couple of years. Additionally, most of the increases in production by Kazatomprom will go to Russia and China. This chart in front of you from Kazatomprom's quarterly report shows the attributable production declining over the last 5 years. You see a couple of red arrows here. Notice that 2025 adjustment or the reduction in this red square is quite large. As I've just mentioned, bringing 2025 guidance from around 82 million pounds down to around 67 million pounds. Combining the demand and supply developments that we've discussed so far, it's only logical that we move on to deficits. The above mentioned demand and supply developments will surely lead to uranium deficits in the next few years. The Energy Information Administration in the US estimates that the US utilities will need around 433 million pounds of uranium over the next 10 years until 2033. Again, that's just in the US. Out of that, only 249 million pounds have been contracted, and around 184 million pounds represent the largest ever unfulfilled, uncontracted yet amount. Hence, the long-term outlook for uranium prices is bullish, especially for production in the US and Canada, as supplies from Russia and Kazakhstan are declining. The outlook even further into 2040 suggests an annual requirement of 300 million pounds per year, which is almost doubling of current production. Hence, deficits are on the horizon. Moving on to contracting, uranium purchases by utilities in 2023 were at the highest level in at least 11 years. 2023 was the first year of replacement rate contracting, so there is still a long way to go in this contracting cycle. While the start of 2024 contracting was relatively slow, it has accelerated recently. Usually, contracting speeds up into autumn. During January through August 2024, utilities purchased 29.1 million pounds on the spot market and 44.2 million pounds via long-term contracts. These numbers exclude undisclosed volumes, so given some underreporting of long-term contracts, the true volumes are higher. As I mentioned, long-term contracts often accelerate into autumn, so there is still a chance for 2024 contracting perhaps to catch up with 2023 and even possibly exceed it. Talking about contracting, Brandon Munro from Bannerman Energy commented at the recent World Nuclear Association Fuel Report that contracting and spot purchases by end users has still not reached replacement level contracting. The utilities are not buying enough uranium to restock their inventories, and with the purchases postponed, it's therefore not exposing the deficits yet. But those inventories, however, cannot stretch forever, so significantly higher uranium prices are eventually coming. Hence, we're moving on to our price section of this uranium report. As Mike Alkin from Sachem Cove, a large uranium-focused fund, also recently commented, the real bull market has not happened yet. The utilities continue avoiding large volume long-term contracts. That moment is coming. Yet during 2024, uranium price declined from around $106 to around $80. But the contracted long-term price has not declined. That's the black line on your screen. Long-term price usually declines in a bear market, which finished in late 2016. Perhaps spot price simply got a little overextended recently and is temporarily correcting back to support. By the way, the long-term price is now at the highest level since 2008. That's the highest in 16 years. And we have this highest level even before the contracting volumes have spiked. Looking forward, notice how contracting volumes, the blue bars, especially within that red highlighted area, increased in the bull market during 2025 to 2012. Given the deficits discussed a minute ago, if volumes spike to say around 250 million pounds per year again, how do you think would uranium prices react? Let me know about your best case projections down in the comments below. Given the deficits, Planisphere Investments estimates that prices must exceed the marginal cost of production, currently around $95 per pound, by at least 30%. So exceed that by at least 30% to incentivize producers to invest in new projects. And if uranium prices rise by at least 30% from here, how much would the producers rally? Again, let me know what you think about it down in the comments below. Of course, if a severe recession hits, then a collapse in the general stock market would pull uranium producers down temporarily. Looking at the producers, URNM in front of you, it's over 10% below the 50-week moving average. The last time URNM was that far below the 50-week moving average, that was in 2022, it represented a nice buying opportunity. So there is your food for thought, not necessarily call for action, as I'm not your investment advisor. For part 2 of a more detailed uranium report, make sure to join us at myfinancesteacher.org. Have a great day. Bye bye.